So your first check is the riskiest check. Because it's the highest risk part of the journey, it's also the highest reward part of the journey if you do well. 95% of investors in India are averse to touch something like this because these kind of businesses don't make revenue.
You are an early stage fund. You would invest in companies at the pre-seed, seed, maybe maximum Series A level.
Dr. Ritu Verma is the founder of Ankur Capital, an early-stage venture capital fund backing deep science startups. Ankur Capital manages more than $200 million, helping India build IP-led global companies.
Biggest change, Akshay, is entrepreneurs and talent. That is the absolute critical ingredient without which capital doesn't flow. If you hire somebody who's mediocre, you are sunk. We had 100,000 patent filings last year in India, but 50% of this was
Ritu, welcome to the Founder Thesis podcast. I want to learn from you how easy or how hard it is to launch a venture capital fund in India. And let me first understand a little bit about your background. You've had a fascinating journey yourself. Just take me through your journey a bit before we come to the launch of Ankur Capital.
So I started life out as a physicist. I have a PhD in physics from the University of Pennsylvania. So I think I was always interested.
What made you go outside India?
I don't remember. Friends who were going outside India. Sort of, that's what people were doing. So I don't think it was in my case, it wasn't a very concerted thing that we were going outside India. It was just easier than, and friends were doing it, so why not? So that's really how it worked for me. But yes, I did my undergrad outside India, and then I obviously stayed on to do a PhD post that, essentially. But I started life out as a physicist. So in reflection, obviously, somewhere I was interested in science. I was interested in innovation. But I did realize throughout this PhD that, an academic career was not what I was interested in. I was just interested in, I was what they call an experimental physicist. So my father once said, I was a plumber and an electrician combined because I was only fixing things every day in the lab is what I was doing. But so I wanted the more practical. I wanted to sort of have things actually come out in the real world versus, being taken up by writing papers. So that's really, on reflection, I realized all of this. Maybe I didn't at that point in time. But that led me to a couple of jobs, all of which were in product innovation. Actually, they were with larger companies. So people like Unilever, people like Philips. And I was always on the product innovation of bringing product to market, from R&D to product innovation to market is what I did globally. And with a stint in India as well. And of course, there was the second realization here that, look, the risk appetite for innovation in such a mega company is limited. And I really should be, in this more risky startup world is what was sort of interesting to me. Now, barring the lack of having a very specific idea that I wanted to build a company on, the next best thing was to be on the capital side and sort of actually enable a lot of such innovations to kind of happen. I got a chance to do this alongside a CVC a long time back. That was, and it gave me a flavor for what, some very, very fundamental technologies. And this was lithium. Lithium was coming online across the globe. So I was sold. This is really where I should be. So moved back to India. And, that's really when, sort of Rama and I met and, we started talking and had some similar sort of approaches, similar kind of things. We started dabbling. That's really how it all started.
So, did you have some sort of role model in place that, okay, I want to start something like this? And was it clear to you that what you'll start is a fund? How did that journey happen from quitting a job to starting Ankur Capital?
So I think, the fund in its current concept in India as an AIF was not necessarily the North Star here. right? I think Ram and I dabbled in a bunch of other kind of constructs of how to do it. I think giving equity to a startup and watching that equity grow while supporting that startup was at the crux of it, right? And I think that's coming from, both of us having coming from operating backgrounds. I spoke about the fact about innovation, risk, and the capital side of, what that kind of enables, right? So whether this was in a fund or whether this was out of a balance sheet, etc., was not necessarily, the underlying piece. Of course, you realize there are limitations for the structural innovations that you can do. So you should just shut up and just do a fund and just work with that scenario. So if you look at our journey, the first part, there was a bit of warehousing, there was a bit of proprietary capital, there was our capital. So it was a blend of stuff as you kind of did. But at one point, we did come to the realization, look, if you have to grow and scale this, and India was growing, and the opportunity set was growing, you really needed to formalize it because that's how capital actually moves through formal structures as opposed to, SPVs and all of that stuff, right? The larger capital was not really done.
What do these terms mean? You said there was warehousing. What does that mean?
You're managing an investment for someone else, right? So you have an investment, you convince somebody, it's actually on their books. You're managing, they're paying you to sort of manage this, some of those kind of things, basically.
Okay. And you said proprietary funds. What does that mean?
Just people, some angels, friends, families who was willing to give us some capital to play with, kind of pieces. Yeah, right.
Okay. As opposed to say a
and in
family
India at that
office or
time,
institution.
No, so all of these things are brand new terms. Fairly recent, right? We have forgotten where we were in India. Let's say 2014, 2015, right? Where we were. Right. So, I have been in people's offices in which literally it's a family, you'd call it a family office today. And in those days, you just talked to the family or the proprietor, I should say, right? There was no family office person. It wasn't even called a family office. It was just called, I'm a rich man, basically. And here's what I'd like to think about doing with the money. So you come to me with an idea. And, we had all sorts of absolutely fascinating conversations. I think we should write a book at some point about some of these conversations, because the concept of giving somebody else the money to manage was very alien, right? So we were at a very early stage of all of that. My money is my money. You can come and I might pay you a sliver or something like that, right? People would say, "Kitne takke milenge?" It was just a very different mindset, right? They were used to maybe giving out a loan to somebody and sort of getting some interest, right? But the fact that I could give you money for the long term, people said, "What, you want this money?" And our first fund life has a very weird fund life, like 7 years. Now I have trouble explaining it to everybody. But if we said 8 years or 10 years, people would say, "I'll be dead. What is the point?" So you would hear some of these things, right? So you had to kind of navigate some of those pieces. So I think the India ecosystem has come, so far that, the words you're using were just not there.
Most VCs that I have interviewed come from one of the following backgrounds. So say someone like Sasha Mirchandani from K. So there was family money, which was kind of used to bootstrap and start the fund. A lot of people are people who worked at other VC funds or were investment bankers, so who are more from the wealth lens, like this is a wealth management business. How did you two, both of you are not from like a wealth management background, probably did not have rich friends who could give you money. How did you actually put together Fund 1? I believe your first fund was about a 50
By the
crore
scruff
fund.
Yes. So hard journey. You started by asking the question, how easy is it to set up a fund? I think it's never easy, right? And I think if you're coming from wealth, it's a different scenario because you seed that all, right? So for us, it was, absolutely scrappy journey, basically, right? You're talking about a market that doesn't really understand the asset class. Okay. You're talking about, not being able to bankroll this, right? At some number, essentially, that, if you come from wealth or whatever that you sort of have, right? You're talking of coming and say that you already have an investing track record. I mean, I had some investing track record, but not really a full track record, I would say, right? Yeah. So, all of these things are hard things, right? So, but the Akshay, there's something called an angel, and I think when you set up something, and a fund is a startup too, it's not very different. You totally understand the meaning of that word. I met a gentleman, in Colorado who had never met me, nor had I met him. On the spot, he said, "I'll give you $150,000. Right? So, so it takes people like those to get things like this off the ground. Right? And, thanks to them, we were able to get off ground.
Got it. Okay. And what kind of thesis did you launch with? What kind of investments were you looking at? How were you doing deal sourcing and deal diligence? And help me understand that.
Yeah, I think, one of the things that we were saying, so we were working with startups. Rama and I were working with startups, and that's how we met. Basically, you'd call that thing an accelerator today or something like that. But those days, God knows what it was, right? Their point, it was a fuzzy thing here. But so the thing that you saw, and I was coming, as I said, from this background of actually having looked at very fundamental innovations, right? If you're looking at lithium, and, if you're working with a CVC who's looking for very strong intellectual property, they're looking for strategic interests of what are going to be mega markets, right? And that's not what you were seeing in India. What you were seeing in India, and I tried doing that for them actually in India, and honestly, there was nothing really from their lens there, right? But what there was, sort of forays of technology, right? The mobile phone was coming online. There were entrepreneurs who were using that and, coming up with sort of fairly interesting models in areas that you might otherwise think are just absolutely, not the natural place to invest. So as a thesis where we started, and this is probably also coming from what we understood from our backgrounds, we were looking at the mass market, Akshay, right? And we were looking at what are the potential technology-led companies that can be there and play a role, right? Today, everybody is talking about tier 2, tier 3 or whatever. We started with tier 3, tier 2 India because you could see, I had worked for Hindustan Unilever for some part of my career, and Hindustan Unilever is very good of just throwing you into the mass markets and saying, go figure it out. And you see that there's a vibrant market there if you get the product market fit right. And, we were seeing technology-led businesses that were trying to address these markets. So I think our focus was on how could we be looking at some of these technology companies that were looking at these mass markets to create large businesses. So I think that's really where we started, and that was our thesis.
Okay. Probably at that time, impact investing would not have been a thing, but is this what you would call impact investing?
So, Akshay, that word impact investing is fairly loaded. So, for us, there was a particular thesis in mind. It was beneficial to people who perhaps were not, these are not the top 100 million people of consumers in India. We were not necessarily looking at a consumer story, right? We were looking at a more of a economy story where production, supply, these were all kinds of things that you had here. It wasn't just about saying, hey, who's going to buy more toothpaste, right? Or jeans or whatever, right? That was not really the only story that we were sort of looking at, right? But I think what you see is that, people just have very specific views on what impact investing was. And this was around then, right? So the microfinance industry was around. So that was definitely impact investing, right? But, we see, some of the things that for us were fairly impactful don't necessarily cut lens for everybody, right? So I think it's a complex thing to answer, right? It wasn't traditional impact investing, but there were parts of it that you could say, hey, fit the bucket.
So, cut to today, you've had a second fund of, I think, 300 plus year, and now you're on fund three. I believe fund three is 1,200 crore?
We're targeting 1,200 crores, yes.
1,200, okay. So, what has changed from 2014 to today?
Everything. I mean, to me, the biggest change, Akshay, is entrepreneurs, right? And talent. Those are the two things. Then that is the absolute critical ingredient without which capital doesn't flow. Nothing happens, right? So, 10 years back, folks were absolutely, let's put it, you had to be crazy, as they say. You had to be very passionate. You had to build not just what you wanted to build, you had to build all sorts of adjacencies next to you to sort of build a business, right? And, as an investor, God knows where exit was going to come from, right? I mean, that was a question that everybody asked, and yeah, you said something, right? Now you fast forward, and at the startup level, hiring was really, really difficult. We made an investment in the northeast of India. We couldn't find an accountant in the northeast of India that was willing to work at a startup. Okay, so you realize why you have mega centers, because people willing to take that risk appetite as a talent. You don't want to spend forever trying to find an accountant. I'm not even talking about, enablers. This is a very basic hygiene job, right? At the end of it. So today there are entrepreneurs, there are people willing to take the risk. And what's interesting is that there are people willing to take the risk who've had careers and potentially, careers that they could continue to have, right, with stable jobs, right, willing to jump off that bandwagon and say, just met an entrepreneur a couple of days back and he said, I had a very fancy job, but said, look, guess what, I think I should do a startup, right, essentially. Moreover, you have people who are willing to join. The value of ESOPs is something that got proven in the market. So people are like, hey, in the heyday of 21, I think employees were collecting a portfolio of ESOPs, right, is what they were doing, switching from one company to the other. So to me, that's the biggest change, right, that there are people willing to actually undergo the journey and actually tap into the opportunities that India represents. And to me, that's the biggest change here. And then there's all these things, the associated system. And I think of the venture capital industry as the associated system around an entrepreneur. We now know the language of family office. We now know the language of venture capital versus private equity versus, venture debt versus do all these things. And you can walk around and people will say, oh yeah, I know what that is, right? We can talk about secondary funds. We can talk about the IPO market, right? We can talk about actual exits that have happened, right? Not one, many, okay? We can talk about the time frames that has taken. So much has developed over the last decade, right? And so it's a new space, I think, for it's a great space for any entrepreneur, if you ask me.
What are the sources of capital for a VC fund? Whom all? What's the universe of people that you can tap into for? You're currently raising 1,200 crores for fund three. So what's the universe of providers that you're going to raise this money?
I mean, it ranges from a lot of institutional capital to family office money.
Give me some examples also, like
so for example, we have like the BII, which is a UK investment firm that's invested in us. You have the government of India who's an investor in us. You have large family offices that are investors. So it's a gamut. Family offices in India, family offices outside India. So, the gamut is quite large, actually, right? And, people have woken up to India outside India. So that's a good thing. People in India have woken up to India, which is also a good thing. So, some of these things are, the base is much broader.
So you are an early stage fund, right? You would invest in companies at the seed, pre-seed, maybe maximum Series A level.
So we invest in what we call pre-series A. Yeah. And
Okay.
I know these definitions move around, the quantum of money moves around. The way I think we like to define it is that, there is something you have done, right? So I can take a look at it and say, okay, get some kind of assessment of what you're talking about, right? So you may have small revenues, maybe you may just have a product, but you've done something. So it's not like a drawing on a napkin, typically, right? Once in a while we have done those, but those people are just kind of rinsing and repeating things that they have done versus starting something completely different. So there's some track record on that piece, but that's really where we come in.
Okay. So for growth stage funds, like for example, retirement fund, these large institutional investors, like say a retirement fund or a sovereign wealth fund, do they invest in the early stage fund, the kind of fund that you are?
Absolutely. I
Okay.
mean, it's the risk reward spectrum, right? Obviously, you don't put all your money into it, right? But there's very sophisticated asset allocation strategies depending on what your target rate of returns are, right? To get this compounding in the public markets over 10 years, in India, you'll often hear, oh, the public market's doing better than what VC returns are or things like that, right? But the question is the power of compounding over 10 years, right? So can you get that public market to perform at 25% year on year for the next 10 years? I don't know, maybe, but that falls into their risk bucket. It's depending on the type of institution you are, it actually can be a significant allocation to private markets. Of course, you'll blend there between early and late, but absolutely, they are the typical venture capital funders actually.
And what is the return profile that investors expect when putting money into an early stage fund? You said 25%. That's like a hypothetical number.
No. No. I'm just tossing a number out there. I think people would like you to get, so I'm talking about early stage VC. So I think it's, between 4 to 6x of what they have given you.
Okay. Over 8 years or a 10 year
8 to 10
period?
years,
Yeah. 8 to 10 year period.
Yeah.
Okay.
So typically around you're talking about, a net of 25 to 30% IRR here in our place worth.
Okay. And how many early stage funds actually meet this kind of return profile?
It's a power law. No, not everybody meets this kind of return, right? I think there's lots of factors here, right? And you can say there's obviously manager selection. That's part of it. But there's also, and that's why, a lot of these investors you will see will diversify, right, over vintage, right? Because market conditions also matter, right? At the end of the day, as to where are you and which part of the cycle are you, right? So that some of that, if the IPO market's closed, it's closed, right? That's not really in your hands. So they would typically, manage this with vintage diversification, manager diversification, geography diversification, so if you have the tools, that's how you kind of manage the fact that not everybody's going to give you this return, right? It can't be that everybody's going to give you a return.
Okay, understood. So we've discussed about the capital providers. Now, I want to understand how you think about, you have this pressure of meeting this 25% rate of return for investors who are giving you money.
Our bar is higher, Akshay. 25 is not our bar. 30% plus is our bar.
30% plus. Okay. So how does it influence the way in which you look at companies when a company comes to you, or when you are building a portfolio of companies? What is the strategy that you follow? How much to give in a company, for how many rounds to stay invested, when to exit? What are those things? You've spent more than a decade, so you must have got a lot of learnings around this.
Yeah. Can I tell you my biggest learning, Akshay? It's multiplication. Okay. So how much money we make in a company is multiplied not just by the valuation, but how many shares we hold too. Right. So it sounds very silly, but it's a reality here. Right. So I think that drives a lot of our strategy. We're expecting every company we go into to be able to, hit it out of the park, which means at least return up front. At least that's the assessment up front. And that's partially because there is a failure rate here, right? And that doesn't necessarily mean there's a failure rate for the company to shut down. There's a failure rate for capital to be realized or the returns to be realized, right? Because maybe slow growth companies may not happen in the time frame we have. Maybe the market wasn't ready. Maybe there are other factors. Multiple things can come to play. Team members left, whatever, right? It's a long race, right? It's not like 6 months, which is much more determinant than what it is for 5, 7, 8 years, right? So that's really our calculation. We like to come in early. We like to, be the first institutional check in the company. We follow our convictions, so we are more than happy to lead. We're not following someone else's conviction. And then we will double down up to about a Series B, and then, our LPs want cash back. So we have to start pulling out of those companies, though there are some mechanisms today that now allow them to hold or, whatever for the longer, if it's a longer gestation term, basically.
So you're saying multiplication, which is the valuation and also the number of shares that you hold. So the reason you want to be a first check is because as a first check, you're likely to have a bigger equity share with lesser money going out for that.
So your first check is the riskiest check, right? At the end of the day. And there's lots of other things can go wrong with later checks too, don't get me wrong, right? But it is at the earliest part of the company. It's the earliest part of a team coming together, market being assessed, the product market fit being established, right? So there are two, reasons for, this is a particular part. So if you were to think of this as a child, it's a particular path of the child's journey here, right? So I think it requires a set of skills. It requires a hustle. It requires a bunch of things for you to work in this space. Versus if you come in at the growth stage and, you're doing an analysis of numbers and you think whether, the EBITDA margin can go up by 2 basis points or whatever else, and figuring some of those things out. There are different elements that come in later, right? So I think that's one part of it, right? Because it's the highest risk part of the journey, it's also the highest reward part of the journey if you do well, right? At the end of it. Because obviously you're not going to come in at the valuation that a Series C investor is going to come in, right? So you're coming in with that early check, and that early check, it drives a lot of your returns if the company were to make it.
Okay. And how do you think about the overall portfolio, the fund allocation, how much to allocate in one company and so on and so forth?
So we all typically have risk limits, right, as to that we set up because you want a diversification. So there is a percentage of companies that will make it, and there's a percentage of companies that won't make it. So you better have enough, statistically a broad enough portfolio to be able to demonstrate that. If you have 2, that's not big enough, right? At the end of the day, right? You have 100, then you better figure out the machinery to manage 100 because it's not so simple, right? So you come up with some kind of balance of what that portfolio is. You limit how much capital goes into one of those. So should it go belly up, what percentage of the fund just gets written off, right? Because if you get 50% of the fund written off, that's just, a different thing to be able to make up, right? It's also, you figure out a risk allocation here of, for capital allocation as to what is the exposure you want to take and how many assets that you want. Yeah. Typically, Akshay, some of this is driven by how much you can manage also, right? It's a lot of work. So, 15, 20, sometimes you'll go to 30, 50, but, it's a very different strategy if I'm going to do 100, right? So that's what it will least.
And what is the average check size and what is the ballpark valuation that you are comfortable with when you are investing in a company?
Our first checks range between like $750,000 to $2 million roughly. Okay. But we do want significant holding for that, right? So definitely double digits, higher double digits is roughly what we want to target with that check.
Okay. And you also want to leave some money for follow-on rounds, like you'd like to stay invested if it's doing well.
Yeah.
Hmm.
Yeah. I
So
mean, it's good
in
that
a
you continue to
sorry.
protect your first check. So you continue to retain your holding here.
Hmm, 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 hmm. So in a like a 1,200 crore fund which you're currently raising, what is the like the number of companies? Do they increase, or does the check size per company increase, and you look for bigger bets, or like how does it scale from a 50 crore fund to a 1,200 crore fund?
So the 50 crore fund, Akshay, had learnings. Okay.
Hmm,
The 50 crore fund is not a real fund in many.
hmm,
I mean, sorry, I shouldn't say it's not a real fund. It is a real fund, right? But there are certain aspects of the strategy that you learn you can't play up. Like, so for example, you can't follow on into a company that's doing well because you don't have the dry powder, right?
right.
So what are you going to do, right? Essentially. So I think the 50 crore fund has a lot of corrections. There is a correction in the India market. Our first check was like $100,000 or $150,000. Like, today $150,000 goes nowhere in a startup. Not just because of a valuation ask, but just because of what you can do with it, right? So I don't consider the 50 crore template necessarily for this fund, right? I think there are two things that a larger fund does. It gives you access to more opportunities. You can expand the size of the fund to be more 2025 kind of companies, and it allows you to participate in your pro rata up to a certain depth more meaningfully. Because so, as I said earlier, you set a risk limit, right? So if you hit your risk limit, you can't put in more money into the company. But the company you may actually have the ability to put in another few more million, but you can't, right? So that's what it unlocks, right? For us, the first set of check sizes don't change, right? It's just the breadth of companies. We feel there's a lot of exciting opportunities in the India market going today and going forward, and the ability to back that, because what you're seeing in the India market is that when companies are doing really well, I mean, they're comparable to a company anywhere, right? Essentially. So they are growing, they are at a pace that is absorbing capital. So if you want to still stay there on a pro rata basis, it's hard to, it's hard to do that without the dry powder.
Okay. Got it. What is the India opportunity? What's your broad thesis of, what our next 10 years going to look like?
Yeah, so I think we've seen some bits of things happen in the past in the India economy. And I think those are just going to amplify. For us, our focus, and we've shifted our focus completely to be on the B2B side. Yeah, so we really, very rarely would we do a B2C company. I think, there is a consumer opportunity, but I think that's not really for us. I think our focus has been on, I would say, 3 buckets, right? The first 2 buckets are all under the digitization in India and the public stacks that have got built, the AI models, etc., that are sort of, becoming ubiquitous. What can you do with those, right? And one thing that's worked for us is that, is like we call it this, is the next, fairly traditional industries, but with this digital lens, with the technology layers sort of coming in, building a new age business that is one of the opportunities in India. We think of India as a very hyper fragmented place. So even in a B2B business, there are Airbnb style opportunities and Uber style opportunities sitting here. So I think that's still an exciting space. We have dabbled in some buckets in that space in the past. They've done really well for us. We have Captain Fresh headed to an IPO, and really the thesis was exactly this. And so we think that there are more opportunities there. I think as more and more digitization comes in, I'll go back to my, our initial thesis of the mass market where, data, information, all of these were fairly expensive to get, to deliver to create products around, right? So no one did it at the end, right? So, but now with a lot of the digital data kind of everybody being online, transactions being online, all of that, I think you just now starting to have a data flow, which I think can drive, a different set of companies, right? So, new products, new services. We just made an investment into a company called Saswat. They are playing on the historical digitization in the dairy industry, which is an absolutely massive industry, to be able to create lending products based on the underlying data of how the dairy supply chain is kind of working, which has 1 million people, not what 1 million, there are hundreds of millions of people kind of interacting with that whole thing, right? And they're all small people; they're not mega people, right? So your HDFC Bank's not going to go out there. I mean, actually, they are doing some of it. Not going to really go out and sort of serve all of this, but a digital first kind of vendor can possibly, right? So that's the second bucket on the digital, I think, right? And, we often get asked this question about AI, but I think AI just pervades all of this, right? So it is about business efficiency. It is about, so we're seeing this across companies. And so that's a segment, I think, in India. And I'll just add that the other thing that we've learned over the last decade, that while this all starts in India, it's relevant for a much larger part of the globe. So there are many parts in India, parts of the world that are the market structures are like India. So, in a tough market, India is a very hard market, right? Like, people aren't throwing, rupees left, right, center to say, let's try. Okay, try. All of that is very hard. So if you get it right here, there are a lot of other markets which has similar market structures, Southeast Asia, even Europe, I would say. Also, this all works in, right, essentially. The third bucket that I spoke about is sort of, Akshay, for me, going back to my roots in some senses. It was something that I just didn't think, or rather had tried in India. I hadn't really found anything in India. But we're seeing a lot of what I call high intellectual property companies, right? So these are based on very foundational technologies. They are world-class, but built with a India competitive edge, essentially. And so I'm talking about things like, new age batteries, bioinformatics, semiconductors, all of these which have grown immensely. I think we put our first check in 2017, 2018. And we've just seen this bucket grow dramatically and sort of actually, so that continues to be something I'm very bullish on.
Okay. So you're fairly sector agnostic, like you do SaaS,
Yes,
also you do
agnostic. Yeah.
deep tech, you do fintech. Okay, understood. So how does
I
it
think
work
the
then?
last bucket requires underwriting skills that are a little different. And, fortunately at Ankur, we sit at those underwriting skills. So that's true story.
Okay, because of your own background as a physicist.
I know we have other team members, we have a biotech person, we have another quantum, quantitative physicist, or, we have a bunch of other teams, we have engineers, etc. in our teams, all of that sort of that support that.
Okay. So when you are evaluating an individual company, what are you looking at? Are you looking at how strong is the IP? Are you looking at distribution? Are you looking at the founding team? What matters when you're making an investment in the early stage?
So it's a little different in each bucket, Akshay, as to what we're looking for. I think the thing that cuts across in early stage investing is, the team/entrepreneur is a very critical people here. So that I think cuts across. I think what cuts across is the market size and the opportunity. In some of the digital companies, the India market size is large enough. For us, any of the deep science investments we make, we're looking at a global market size, right? So what differs is in the digital companies, we are looking to underwrite the risks that whether you will get product market fit or not, right? So this product could be a lending product. This product could be a marketplace. The product could be a bunch of these things. And as I said earlier, we look for some little bit of early revenue traction. So what are you talking about, right? Like, because I can just understand what you're talking about. That doesn't mean that you have product market fit. It's just that, I can wrap my head around something, basically. In the deep science companies, we are not underwriting R&D risk, right? Typically, R&D is done with. We're underwriting the techno-commercial risk here. So can you scale that R&D up to actually get a product at the right price point out in the market? So that is really what we're looking for that. So then the assessment switches, right? So for that techno-commercial scale up, right, I need to understand how this scales up. There are experts globally that have scaled similar kind of technologies, right? Like, what is it there, right? And in those companies, as you said, Akshay, IP is important, right? We're looking at global plays. We're looking at frontier technologies. We're looking as to why your technology will beat the technology coming out of MIT, coming out of, Korea, coming out of Japan. I don't care where, right? So it doesn't really matter. Technology doesn't care where you're coming out of. It's got to be able to beat the others. And that's, and then if it can beat all the others, it's important that you can protect it, right? And so their IP. In the digital companies, we don't really care about the IP. That's not what we're looking at. It's more, market and execution and, how fast can you grow that?
How do you judge the entrepreneur? Like you said, that across all categories, the entrepreneur is the most important thing. So what are you looking for?
That's like $1 billion question, Akshay.
Yeah.
Look, this is a very hard journey, right? So it's a very, very difficult journey. And the journey requires pivots in in yourself, right? So Rama and I running around scrappily making investments day one is not the same situation as it is day two, day whatever, 10 years later, right? That's not really it is, right? So I think you have to be able to pivot yourself through this, right? And that pivot requires you recognizing that you need other people, right, to help scale this. So we're looking, for some sensitivity in entrepreneurs to understand that, because one of the things that you find is people don't hire the best, right? In a really, really hard journey, if you hire somebody who's mediocre, you are sunk. So mediocrity attracts mediocrity, and that's not a good place to be. Better hire the absolute cheap person. That level is my view, right? So you're looking for someone who understands that they have to complement themselves, that they will actually manage to sell a proposition to somebody, to join them, to do this, to build this company. You're looking for someone for who this is a dream, that to make it a big thing, not a small project that, I'm very excited. It's, so some of these characteristics become very important. And, I always tell entrepreneurs, it's not actually me judging what it is. I think you should just ask yourself the question. There are different kinds of businesses in the world, but you shouldn't raise the wrong capital for your business and what you want to do. So very often people don't ask themselves, what do they want to do, right? So if you raise VC money and you really actually have like a 50 crore vision of a business or 100 crore vision of a business that you kind of want to build, you're both going to be unhappy, right? It's the wrong capital, right? So I think we're looking for that match, because this capital requires a journey that is different than building a business over 30 years.
Okay. Is there an alternate model possible where you're not necessarily looking for every company, like your qualifying filter is that every company should hit it out of the park and have like a hockey stick growth, but Like a more...
I told you we experimented a lot. Part of
Hmm.
it was experimenting in some of this stuff,
Hmm.
right? And I think the challenge in the early stages that there is a failure risk, right? So there is a failure risk. That failure risk, there's multiple risks here that make up that, get added up to that failure risk piece here, right? And even if you're running a fairly traditional business, some of that doesn't go away, right? Let's take the team, right? Unless you've been working for 10 years together or whatever else, and you ironed out all the issues between 2 co-founders or 5 co-founders, very possible 2 years into the journey, especially a lot of entrepreneurs are fairly young, right? So it's not like they figure out, you diverge, naturally diverge. There's nothing wrong with that, right? That's really what it is. So some of these risks don't go away, right, is the problem. So you've got to figure out how you make a return, right? How the returns stack up with that risk. So if you're going to have 60% of your money wiped out, and I'm being more generous, right? Because it's obviously larger typically around VC. It says 40% of your money is wiped out, right? The thing you don't have to beat is how do you get that 40% of the money back, right? You have to figure out how to make the return for the LP that's willing to sort of get that in, right? And that's really where that math gets a bit hard. And then you figure out the exit scenario, right? So let's say you invest in a company, maybe they do 1 crore of revenue. Okay, maybe in 8 years or 7 years or 5 years or whatever, they do 20 crores of revenue. Okay, I'm being pretty generous also, right? Because the growth rate's not high. How are you going to leave that company, right? That's also all a bit of a challenge, right? It's not like the company is going to be generating cash crazy that
buy you out.
Buy you, and even if they buy you, what are you going to get bought out at, right? So some of those things are, you've got to solve for some of those things, right? And so, which is why the problem is this capital requires. As soon as you get to later stage, more private equity, it changes, right? Because some of these risks have been taken out of the system.
The failure risk is not there. By then, this
the failure risk has not, it's not that it's not there, it's dropped. It's dropped, right? I mean, you can still have a blow up, like governance blow ups, all sorts of other things. You can look everything and anything can go wrong. That's still true. But some of these sort of other risks have gone out. Like, you may have a professional team in there at this point, at which point the replacements are possible. Like in an early stage, you can't really go hire a CEO, right? Like who are you going to hire, right? At the end. So some of those risks are taken out. So that makes that more amenable to that.
Okay. Interesting. Okay. So I'm wondering, you invest in the deep science space. Would you have invested in Log9? Or have you invested in Log9?
No, we haven't invested in Log9.
Okay. Would you have invested? That might have come across because you also mentioned lithium as a personal area of interest for you. And
we're invested in Zinc, a company called Offgrid Energy Labs, right? They make batteries for long duration storage. So think data centers, think renewable energy grids, etc. Basically, potentially we would have invested in Log9. I think we had looked at the technology. I think one of our evaluations in these deep science companies is you've got to figure out which horizon will this thing get to commercial in, right? Basically, for some of it to make sense. Like there are some very fancy technologies out there, but it'll take time. I mean, lithium didn't come online day 2. The work on it started ages back. So yes, technically, yes. We have looked at that.
Like you felt with Log9, the risk was that time to maturation.
I don't recall fully, Akshay. I have to go back and take a look at the team as to why or whatever. But, I think, we were trying to form our thesis somewhere in the battery space or what we were interested in. We knew we were interested in storage. We still are interested in storage, right? So that was something. So, I think that there have been a thesis mismatch or something there.
Okay. What about something like, say, Resha Mandi? Would you have invested in Resha Mandi?
Yeah, absolutely.
Okay. Like, which, of course, now it has shut down, and but what, like, was there some telltale sign about that this would shut down, or like you would have also invested in it if it had come across?
Um, I don't think there are telltale signs upfront, Akshay, basically, right? So I think the unfortunate challenge with our ecosystem is, see, there's an opportunity and there are entrepreneurs, right? And, you can run that journey many different ways. And unfortunately, when things go south, people write off the opportunity fully. And sometimes they're very dependent on that particular journey or the particular team on how they ran that journey, right? So I think we need to be careful about that. Unfortunately, it's very easy to blame people, blame sectors, all of that. But I think the devil lies in the details. We are bullish about verticalized supply chains. We think there is value creation to be had. There are very large businesses to be built, essentially, and it's a textile value chain, right? So absolutely.
Yeah, what are have you invested in other verticalized supply chain opportunities?
Yeah. Fish.
What are the
We've invested in
like Captain
fruits.
Fresh?
Yes, the fruits, and we grow spices in Big Heart. More spices in Agrozi. So we like these verticalized things as opposed to just I will do anything and everything kind of piece, because it's those, the value extraction gets harder at some of those. So then you start building specialized things for those chains, which then are higher value. It's too hard. So
So,
that piece is
what's
more.
a verticalized supply chain thesis there? Like this would be farm to retail, or is it that?
We're not on retail, basically, so not B2C, as I said. So this is sort of the back end. Basically, it's a very messy back end in a lot of these supply chains, right? You could pick, obviously agri, you can pick textiles, you can pick manufacturing, you can pick, a bunch of any of these pieces, right? And they're all very messy, lots of small guys trying to kind of adapt to connect to a lot of other small guys, essentially, right? So I think a thesis basically is that, look, you come in with a two-sided marketplace here model, right? So it doesn't have to be 100% marketplace. That's not what these typically are. Where there are trust deficits, taking on the risk is an important part. So, it doesn't become 100% marketplace. But, so it's like a shadi.com, right? Is what you're doing. So think of it as like a shadi.com for engineers who only want to marry engineers, right? So that
Okay.
you want to get into like, कि उसने mechanical किया, कहाँ से किया, and whatever else, you want to get into. So it's like, if an apple, like, there's 50 different types of apples, and, we all want 50 different types of apples. So it becomes like a sort of a matchmaking. So then you can start becoming much more finer about it, right? So versus just saying we eat apples and we eat rice and we whatever, so let's just throw everything into the bucket. So, you start getting much more precise, right? In as opposed to throwing it out. So that's why we like some of these. And they're very big markets, right? And I think there's a codification that is required in these markets that we like, which can drive scale. So
what does that mean? Codification?
See, because, when you have a lot of like unstructured products, right? This is not like this is your iPhone 12 over here and you know what an iPhone 12 is, okay? This is, we're talking about a piece of fish, we're talking about an apple, we're talking about a fabricated, screw or a steel sheet, you're talking, So the quality assessment is not a coded.
Like some grading, curation, things like that.
Curation. Those things are quality checks, all of those, to spec. Those things are not that simple. So, here's where this middle intermediary comes in to actually create that system. And with technology, that system, becomes more codified. It's codified. Today, it's not that it's not codified, but it's codified in the heads of like a proprietor sitting in, I don't know, Lato over here, right? Or sitting in Hindi Bazaar or whatever, right? So it's codified there. But hard to find, hard to scale, some of those things
Markets may be wanting something else. It's just a friction process. Yeah.
Okay. Understood. What is your thesis on the energy transition space?
So, two pieces to it, right? I would say one is, basically the way we think about it is that, look, how do you get 24/7 power? Basically is what you need. How do you get cleaner power is what you need. How do you address the electrification needs of a sort of country like India, right? Which is, again, very distributed, but, different issues in different places, some places is that, right? So I think for us, storage and storage solutions form one key part of the energy transition needs. So hence our investment in Offgrid Energy Labs. We just made an investment in a company called Vimano. They make membranes, which are both for storage as well as energy production. So, but we think unlocking, and I think you need different kinds of energy storage, right? To unlock different durations, different, discharge needs, all of those kind of things. So we're bullish on that part of it. But we're also bullish on new energy production, basically, right? So, whether it's hydrogen-led, whether it's, nuclear, but I think we do need other newer sources of energy production. And India's just been great about the renewable adoption, basically. And, we're also seeing hydrogen come into some areas over here, right? So I think those are unlocks. We believe that, for example, some of this will also unlock industrial sectors, where, fossil fuel dependencies are very high. So two buckets, I would say, storage and generation. Both of those are something that we are excited about.
Isn't generation going to be very capital intensive?
So what we're interested in, Akshay, are the technologies for generation, right? So not necessarily looking at somebody setting up a power plant, right? But I'm looking for the underlying technology that will enable that plant. So, for example, let's just take solar. We're not interested in the solar project plants, etc., that come in. But if you come in with a technology here that makes that solar cell much, much more efficient than what it is today, we're interested in that, right? So, for example, at Offgrid, they make these batteries, right? At the end of the day, yes, they're going to be a large manufacturing company that produces batteries, but they're going to sell in to the people who run the projects. They're not going to be the project person.
Okay. After Operation Sindoor, did you also get bullish on defense tech?
Look, I think defense, what I really like about it is not about Operation Sindoor. Maybe Operation Sindoor unlocked the government of India to think about defense a bit differently. Defense globally has always been an enabler of high tech, right? As a customer, right? Because they have the ability to take that risk because they have extreme conditions. So they're willing to try things out, right? So I think some of this IDEX stuff that is kind of happening is great because what it does is it allows there to be a customer, whether that customer is going to be your biggest customer or not, I still don't know, right? There are risks of a single customer and all of that. But what every kind of product company needs is someone to try your products out. And if they pay you for it, so much better, right? Essentially.
Yeah.
So that's what I'm bullish about, that the fact that, at the government of India, we are actually moving the Department of Defense to be, I'll call it guinea pig. If you look globally, defense has been a guinea pig for a lot of technologies because, cost is not an issue there, right? It's performance is the issue, right? So if you can get that performance to work, you then start moving on the cost curves, etc., like here, right? Essentially. So, we are using a lot of technologies that first went into space, for example, right? But obviously at that point, exactly, right? So it enables that. So that's why I'm,
thankful that is kind of happening in the ecosystem.
What's your space tech thesis? Like, are you investing in any companies on space, satellite?
So, I said we invested in a membrane company. So their membranes also go to space. Actually, the first customer is ISRO as to how they go to space, right? Because the membranes also have properties of heat, etc. So yeah, we're interested in new materials in space. I think we're interested in communication-led stuff in space. Maybe maintenance of constellations, etc. So we are interested in some of those things in space.
Yep.
As it gets more privatized, also, right, beyond just defense as a buyer.
So, you did mention about AI as like more of an input. Like everything is AI powered now, but do you have a thesis in the AI space?
Yeah, semiconductors.
Okay.
Yeah, so we're very bullish on, and we just think that there's a lot of stuff in the AI. There's the compute will have and is working differently. So I think you're going to have changes in how this works at the edge, or changes of how this works at the data center. Not everybody has to be an NVIDIA chip sitting and working like 10 million parameter models here, right? So I think we're bullish in the semiconductor space. I think we're seeing very, very interesting and exciting companies in India. There's a large part of the semiconductor talent is Indian, so that is definitely something that we're interested in. I think on the on the algorithm side, model side, I think we've seen some stuff we would really like to see more, but we're seeing more application, and that's what I was referring to earlier. I'm not sure we're seeing too much on the application side. We would really like to see much more. Of the model side, smaller models being built. Maybe, on the physical space, maybe on the, on different types of computes, etc., that might be necessary. So we'd like to see more of that. We're not sort of seeing more of those. And then I think on the agent side, right, I think we have some specific areas that we like, right? So, like different aspects of the market have to come together to make this a valuable business, right? So, maybe like co-pilots or things like that. So, where you're actually doing a very high value job, not a low value job through this piece, and supplementing what might already be a scarce resource. So those are things that we're interested in the AI space.
So these verticalized agents, like say AI agent for lawyers, or a recruiter, like an AI agent who's a recruiter, or an AI agent who's doing customer service, and there are a lot of companies who are going after these areas. Does that interest you?
The answer is depends, Akshay, on the specific type of agent, and that's what I was alluding to. I think, for example, I see our companies who never started out as an AI company implementing AI for customer support, for example, right? With just open source tools that are sitting there, right? And so, I'm left wondering, how much value does an external company capture in this space? If you think about it, it is the first time that this is accessible to people like you and me, without being technical people, because it's interfacing with writing, it's interfacing with voice, it's interfacing with images, right? So it's accessible to any entrepreneur in any business, right? So I think you have to think a bit hard as to whether you will continue to create value capture, or are you just come to some, at some point, like this all becomes very exactly. So I think there's a commoditization of these agents. I was in the US, if you in the Silicon Valley, if you drive it, these agents are on billboards, right? People are advertising them left, right, center. So at some level, I think there's going to be a commoditization there. So, to think on. I think we are much, much more interested in the back of all of this. Okay. So, how is the compute going to work for a million people who will provide agents or build their own agents, right? Are there different kinds of chips that can enable that, which doesn't, can make this a much lower cost base here, right? Are there different kind of data centers here that can actually deal with that versus it all going to the mega guys here, right? So how am I going to service all these guys, right? And I feel there'll be lots of guys. So I don't think it's sort of like going to be one. So that's why it's a little bit of a nuanced answer on what it gets very excited about.
So, India has the talent, like you mentioned, that a lot of chip design talent is Indian talent, but India has not really created IP, like say compared to like say China. Probably the quality of talent is comparable, but China has so much more IP, so many more deep tech startups as compared to India. What's the reason for that?
There's been a lot of investment, Akshay. Okay, so this didn't happen overnight in China. There's been a lot of investment, government investment in the market to enable that, right? And we're just starting, right? So we have our 1 lakh crore RDI fund, and I hope it goes into the right places to actually enable not just catch up, but leapfrog beyond, right? So I really do think that, we used to talk about roti kapda makan. I think we need to talk about energy, compute, and, innovation, right? Here, basically, that if you want to be, at the global forefront, you're going to have to invest in these things, right? So I think the trickle has started. So when I first looked in India in 2008, 2009, I can tell you I was kicked out of one of the most premier institutes in India when I asked about IP, and they said, "Ki ye sab yahan pe nahi hota hai." Right, essentially. Okay. That's not the case today, right? We have companies where their technology has gotten evaluated by a global expert, right? So, for example, at Offgrid, their technology got evaluated by a very large chemical player, global chemical player, and were assessed against any competition, right? And they came back to say, "Hey, I want to invest in you." Okay. So, so I think the tables are turning, right? They're turning, they're not turned. That's not the right word. But you are seeing the shoots for this, right? And I think the playbook for this is also something that hasn't been there in India, right? So 95% of investors in India are averse to touch something like this because these kind of businesses don't make revenue to start with. There's a lot that has to happen before revenue generation can kind of happen. So I think you have to play an enabling role as a government to kind of encourage that. Once you start seeing a few of these churn out, other engineers, other scientists will think, okay, hey, I can actually commercialize this. Today, what are you going to do? Right? So there's a different areas of friction here that will get, and I'm 100% confident it will get. Did you know that, we had 100,000 patent filings last year in India? Typically, this has had much more of global majors filing for patents in India, etc. But last year, 50% of this was domestically filed patents, right? Okay. So you're seeing that increase sort of coming up, right? So slowly but surely you're seeing that. And if we get the other pieces kind of right, I think this will leapfrog. Innately, there are some absolutely amazing technologies sitting in India, right? You need the other stuff around it to actually get them up.
What kind of technologies are sitting in India?
We've seen a range of these, Akshay, right? So, from in bio to some novel drugs, we've seen, specialty chemicals. So across the board, right? There are things. Right?
Things which are solving India-specific problems.
There are global problems. That's what I'm talking about. I'm not talking about this being just about solving India's problems. These are global problems. These are not, technology typically solves global problems. What happens in India is that, look, as as a researcher or a whatever, right? I'm sitting in a context. So we have this company called String Bio, and they're a precision fermentation company. And what that means is they work with, organisms that take in methane as a feedstock and produce proteins which go into multiple different industries, right? One of the use cases for the biostimulant that they produce out of this way goes into paddy fields and, increases yields by 30%, decreases, greenhouse gas emissions by 50%, right? Now, if you look at a lot of the people working with this kind of technology in the West, they were focused on making proteins for people to eat because that's what people do there, right? Rice is not a local problem. Rice is an India problem, right? So you see a context that sort of comes in because you are here, right? So I think you will solve India's problems, but I think you will solve much more than India's problems as well, right? So I think that's really, you can see it once you see these companies. And they're different, right? There are 500 protein companies sitting in the Bay Area, right? But there isn't a single person looking at, they're all talking about decarbonization with whatever, livestock and all this good stuff, right? Rice is a large emitter. Where are the solutions for that, right? It's not in my backyard, so I'm not thinking about it. That's how it works.
Right. Yeah. A lot of the meat replacement companies don't make sense in India because
they don't make
India is
sense
not
in India.
Yeah, India's not meat crazy anyway, so it's not like you need to.
No, I mean, I
create
remember
the
going to
perfect
some
hamburger steak or something like that.
Forget that. I got a medu vada served to me, calling this a lentil burger, something, and I'm just like, ये तो इंडिया में नहीं चलेगा, ये तो जहाँ चाहो मिल जाएगा, so, I had like jackfruit as pulled pork, I'm like, okay. Also some interesting things, man. I think it's just discovery of new things. But perhaps those don't work, right? At the end of the day.
Exactly.
Yeah.
Okay. So, besides giving money to companies, how else do you, what else do you do to hit your return? You want to hit a 30% return on invested capital. And you said it's pretty operationally intensive. Why is it operationally intensive to invest in startups? What all are you doing for them?
Because once we're invested, we have to do everything. That's how we look at it. Okay. So, you call me up and say you want to connect with somebody. I don't know the person, but I need to hustle to go find someone who does to be able to make that connection for it. Right. You need to raise money. You hired some nice fancy banker. And at the end of 3 months, the banker says, "Kuch hua nahi." The problem hasn't gone. It's still our problem. Right. As I said, it's a very difficult journey. And one of the things that you realize about this journey is that, you're in the weeds, right? So entrepreneurs who do well always form sounding boards around them. They say, look, this is what I'm saying. Does it smell right? Does it sound right? Whatever. You end up playing that role. I think sometimes you end up playing like, it's a whole bag of things, right? So if you get a call at midnight, you get a call at midnight. That's what it is, right? I mean, you have invested in a 9-to-5 business. So if the business is working at midnight, at some level, you have to do stuff. So it's a range of stuff, right? I think it does break down into buckets, Akshay. I think there is strategic things. There is sort of being able to help to get business, talent, recruitment, etc. at the company, which I think is more tactical and operational, right? And there is fundraising, I think. And the fourth bucket I would put, and not the beast in some ways, but you're at some way a support system for the entrepreneur if things work, right? And it's I don't think we in the Indian ecosystem we yet have a structured, what should I say, leadership for entrepreneur kind of pieces happening. So you end up fielding some of that as well, basically. So that's why it's. And I think what's intensive about it is that it's not on a schedule. Right? So, you could have issues going on, or you could have things needed at 5 companies at one time, right? Which is why you made the bandwidth to be able to sort of manage that.
You're also doing some ecosystem stuff, right? Like Tech Sprouts, Deep Science Forum. What are these, and how do they help you as a fund?
Yeah, I think our first initiative, this thing was called ThinkAg. Yeah. So this was, we just found ourselves drawn into the agri space, a lot of interesting and exciting opportunities, not something that most people wanted to look at, but, absolutely massive market with very little technology, etc. in it. So what you find is that when you're looking at offbeat markets, right, you have to sort of play this ecosystem support. So I know we were running around doing biz dev for one company. I remember the entrepreneur telling us, you are the investor who gets us business connects here. Okay. Like basically on the call. So, we're like, okay, but, we can do this for one company or two companies, but, startups need a village. So we have to help seed a village of some sorts here, right? And that really was the objective for us to start ThinkAg. We started with 3 other gentlemen with very deep experience in the ag space. I think we are the odd one out in the scenario. But to be able to create that community, and today all our entrepreneurs and other entrepreneurs also sort of go there, right? So I think for us it's good because, it's a place for our entrepreneurs to go to get business connects.
ThinkAg is like, say, you have this SaaS boomy for SaaS founders, something like that?
Yeah, you could say it's something like that, right? But there, it's got industries, the stakeholders to it sort of has to follow the market structure of that industry, right? Basically, to some extent. So, it's a place for folks to get together. It's good for, let's say, ag businesses or corporates in India. It's good for the government of India. It here's what the innovations are kind of happening, right? So it's a place for people to kind of, connect, learn, that kind of stuff.
Okay.
So for us,
like a NASCOM in a way.
Yeah, exactly. So, we started with the NASCOM ag, and it's what we started, right?
Okay.
And so I think the learning for us was that, if you seed some of these kind of systems, they're good for our entrepreneurs, right? They're good for us. We're we're investing in the space. So, you're about as deep in the space as you can potentially get, right? So if I have to call somebody up for due diligence, that's a simple thing to do, right? Essentially. And you're meeting other entrepreneurs, you're seeing what the innovations in the ecosystem are, right? So, all in all, it's a good thing, right? And it's a larger thing. It's not just Ankur's thing, it's a larger thing. But I think that larger ecosystem benefits everyone, but it benefits us as well. So that's really what it is. And that's really what we're doing with the Deep Science Forum. So if you're free, please do come. We're hosting one on January 12th, 13th in Bangalore. But again, it's an ecosystem which is very, it needs different actors to sort of come together, and the space for people to actually come and talk about, because the journeys from India are different, right? There are other people who've done these journeys, so come share, right? So, for example, we have the ex-CTO of Halliburton Labs coming to talk about, his experiences. So, it's a place for people to kind of learn, is how I would say. And for entrepreneurs, basically, I would say, and partnerships.
So it's like an offline community event. People meet.
Yeah, it's an offline community. Learn. Just what are playbooks? Who are potentially interested? What are the challenges that, the first deep tech entrepreneur in India faced? What is different now? There were just different conversations. There are people trying to help with manufacturing for deep tech, right? Sort of building like kind of a timeshare manufacturing plants, right? So again, useful for a startup to say, hey, how do I work with these guys? So, so the different aspects, IP, for example, right? It sounds very simple, but IP is not filing one patent. IP is a strategy of what you disclose and what you don't disclose, what you ring fence and what you don't ring fence, right? We don't have these conversations happening anywhere, right? So we have a lot of incubation happening, okay, in academic institutions, etc. But this is more focused on commercialization of these kind of ideas. And, you have to get into the nuts and bolts of manufacturing. So who the hell is going to help you set up a manufacturing plant? You were a researcher in a lab. You didn't build plants to spec. Supply chains, not, partnerships, very difficult. You're a young startup. If you have an exciting technology and a big company is interested in it, navigating that is a nightmare from hell, right? We just recently spoke to an entrepreneur who signed away the upside to a large company because she didn't have the advice to say, look, let's don't agree. It was just very exciting that, okay, this big company is interested in what I have innovated. But should the product go anywhere? The upside's not hers, it's the company's. Right? So these are things that, we don't have a place that people go to. And so the idea here is, how do I pull that piece in? How can we sort of create that village where more of these can thrive and we can invest in more? So...
What has been the way in which you have seen exits? I think there's yet to be an IPO, right? I mean, Captain Fresh is not IPO'd yet. Anyone else in your portfolio who's like nearing IPO? Or
This
what are
is
the
our
other ways
first
in which...
IPO, so we're very excited. It's 5 years, Akshay. Okay, so it's against all logic if you ask me. So hats off to Uttam for having the dream, but also having the execution to sort of push through that, really, right? So I think it's a very interesting time. We've just had a spate of IPOs. You can call them good, bad, ugly, market not happy with this, market not happy with it. But the reality is it's there, right? Essentially. It's there, and I hope it's there to stay, and that we just now don't get into reversal mode because someone's gotten messed up over here, etc. The appetite is there, right? And I think that's really sort of the interesting piece of the market here. In addition, I will say what else has sort of come about is that there's a lot of more activity on secondary funds, which also wasn't there in India. So I always think of this kind of investing, especially for longer duration stuff, is a relay race, right? So you come in for leg 1, you come in for leg 2, whatever. So the leg 2, leg 3, leg 4 have to happen, right? Essentially. So secondary funds are one of those things. More growth investors are one more of those things, pre-IPO investors. So the capital stack is filling out, which is a good thing, right? So I think there are other exit modalities. And last but not the least, right, but the Indian family office has all of a sudden woken up and said, hey, this is interesting. So whether it's pre-IPO subscriptions, whether it's Series B or C, even A and Bs, I would say, all of a sudden, and we do have capital, we do have domestic capital, and, them coming in is to provide liquidity actually, right, is a good thing. So I think these 3 things have opened up on the exit front. The one that hasn't is the M&A market. Yeah. And I think that's a little cultural. We're not used to buying, we're used to building. So, a lot of incumbents have grown up in an era where, 20% se zyada growth kaise ho sakta? Not really believing, trusting, or adapting to market changes, let's say. But mostly cultural, like I've been in control fully, right? Like an M&A, am I getting sold a lemon? Just concerns about all of those things. And then wanting to beat the price down to nothing. Literally,
Yeah,
right? At which point,
I think M&A in India only happens when there's a deal. Like we are like bargain hunters by nature. It's in our DNA.
So we are bargain hunters. So pehla question is, discount kitna hai? I mean, that's the first question, right? And you're like, do you not care ki karta kya hai? Discount kitna hai? So pehla baat hai is the first question. And you're wondering, if I tell you there's a discount, does it still make this attractive to you, or what is the dealing, right? So that is one part. Hai. But I think maybe the new age companies are examples of this. There are obviously instances of companies that have rolled up smaller companies saying, hey, I want to sort of grow faster. These guys have figured out this part of it. Why build it? Let me buy it, right? So you're seeing that change in the next generation of companies. But, the older, larger incumbents, again, still they are not in the market for this.
All right, understood. How does running a VC fund lead to wealth creation for you? What's the economics of it for you? Like how do you, as the managing partners, the two of you, make wealth?
You have a carry, right? So like any other VC fund.
So carry is like
I
a
think.
profit share. Like if you
Yeah.
achieve that 30% return on the wealth
Yeah.
invested, then
Yeah.
a certain percentage of that upside you will keep.
Yeah. It's pretty standard.
And sorry?
It's pretty standard.
Hmm. And for the day-to-day running of the fund, how does that happen?
You get paid a management fee, right?
Okay.
But that is not wealth creation.
Hmm.
I mean, I think
That's
if
just
you're
to pay the bills.
a multi-billion-dollar AUM or something, maybe it's wealth creation. But these small firms, these are not wealth creation, essentially. Right?
So what's your ambition? Do you want to remain in your niche of early stage investing, or do you want to go beyond early stage and become like a Sequoia or something like that? Or like, what do you aspire?
Yeah, no, I think we would like to grow the products, if I may say. So I think the core for us is underwriting innovation. One obvious place for us to actually grow is to go into sort of the growth stage, right? You already know the companies, you can, sort of lead to sort of underwriting that essentially. So I think those are things that we are adding on essentially to what we do. So I think it will be, different stages, may say that we would add on separate funds to sort of look at that space.
So
I mean, I think
ideally, your
from an ambition
next fund
price,
would
I
be
think we would like Ankur to be. So I would prefer to say the vision for Ankur is that we've actually created the, 100 iconic companies out of India, basically, right? And whether we do this through one fund or 5 funds, I'm agnostic to that, but we will do the.
So let me end with this. What advice do you have for founders in India?
Become a founder, build. The opportunity is there. So if you think of the long term, if you think about the value and the change that you can create, you have to keep that in mind, right? To drive this journey, do it essentially. Right?
What are like the most common mistakes you see founders making, which you'd like to advise them about?
I think the common mistake, and I hesitate to call it a mistake, right? I think we all would do it, right? So I'm not just a mistake, right? I think, one I already said, like, what is it that you want to do, right? Because you'll only do what you want to do, right? That's the edge, right? If you, just retrospecting a bit about like, what is it that you would sort of like to do with it, right? I think the other is, just understanding the journey, right? That, and that goes into you deciding whether this is something for you or not for you, right? That what does this journey of raising money and, all of that involve? Because I think it sounds very fancy. It's a lot less fancier than you think. It's not. Capital requires discipline. Capital requires, a journey for its return, and that is something to think about, right? And the third I would say is that very few entrepreneurs would describe themselves as an investor, okay? But they are the investor, right? They are the ultimate investor because you are putting these into projects, you are putting these into things, right? And your assessment of why you're putting these into things, there has to be some discipline to that piece, right? There's opportunity, but there has to be some discipline to it. But, ultimately, it's you are vested in one company, and that company, has to, if it is to succeed, it has to drive returns. And so you really have to think about how you invest that money. We'll all get things wrong, but if you don't think of yourself as the investor, And if you think of this as just, basically underwriting costs, then I think you lose the plot of what exactly you're doing.
What's an example of this change of thinking, like to think like an investor?
You have 5 things you could put behind, right? A project, right? So, I mean, we have lots of entrepreneurs that are trying A, B, C, D. Okay, if I just take an early stage example, okay? Now, you really have to keep the eye on the ball to figure out whether A, B, and C is, you may have A and B doing well, C and D not doing well. Okay, simple decision, I don't do C and D, okay? But with A and B, the growth rate, the return profile might be different, right? So and if you have to make a choice between the money and whether you're going to put it in A and B, you need to think about that. Now, if you split it into half and say, I'll put it in A and I will put it in B, it's like saying, here's a half a tank of petrol, go from Bombay to Delhi, pahuncho Guinea, right? So,
Okay.
I mean, it just comes to thinking about what is, I am funding this. I have raised the money with my equity, right, to fund this project. So I should want a return out of that, essentially. So I need to think about that. And also, most entrepreneurs realize this. They may not start there, but they realize this, right? And they become good investors, actually. And they shut down things that are not working. They'll put the money, some may be calls, whatever. They will take some of those calls and say, okay, here's what I think that be good for the business. So let's put this in here.
Fascinating. I love that insight. On that note, thank you so much for your time, Ritu. It was a real pleasure.
Thank you, Akshay. Good to chat.